Hi there, James Good with an On the Money market update for Tuesday, the 16th of October. Now, I wanted to point up something significant I noticed in the weekly chart of the US dollar. As you know, the negative correlation between movements in the dollar and movements of risk assets of all kinds, including stocks, commodities, and metals, has persisted over recent years, so we need to keep an eye on what's happening to the greenback, because if we can get that call right, we can often be right on the next directional move for our other risk assets. Now, all those cliches you hear about the impossibility of timing tops and bottoms, all those lazy old saws they come out with, like they don't ring a bell at the bottom, and tops are a process, not an event. Well, I've got to say, 99% of the time, these are nothing but excuses from people who have failed at market timing because they haven't bothered to take enough time to study. Well, let me try and justify that with a classic example. Here is the dollar at the peak of its secular boom between 1999 and 2003. Weekly chart, RSI in the top pane. Price in a strong uptrend. RSI bumping along the ceiling. While rookie technicians are tearing their hair out because the dollar train rolls over every single overbought signal, old hands are watching the lows of the indicator as well as the highs. A higher low in price in early 2001, a lower low, much lower low in momentum. Look at the persistence of the selling pressure. That's what the RSI has picked up here. When you get a surge in downside momentum, even as price is setting a higher low and the crowd is all bulled up and CNBC pundits are telling you everything's great, you have an edge as a trader and as an investor, because very often the next rally, the very next rally, will prove to be the termination of the medium or the longer term trend. And that probability was given even more weight because of the divergence between a new price high and a lower momentum high. Let's take a look at the dollar since 2004. The blue horizontal lines are long-term support and resistance. Now, I've highlighted every instance where price has set an equal or higher low, but momentum has set a lower low. In 2004, you got one more rally before a significant decline. In 2005, higher low in price, lower low in momentum. You got one more rally before a significant and persistent decline. In 2008, same again. Heavy selling pressure, lower momentum low. One more rally before a significant decline. In 2010, again, persistent selling, a lower low, even though you got in momentum, even though you got a higher low in price. One more little feeble rally before more selling in the dollar. So, I mean, you may get the rallies may or may not set new highs, and they may or may not set up divergences between a higher high in price and a lower high in momentum. But the indicator has flashed its warning light already. Big players are selling into strength. So what's happening in 2012? Okay, here's the peak in July. Heavy selling pressure followed into September, but the dollar held its uptrend with a higher low. Momentum, meanwhile, fell substantially to a lower low. Now, in the last 4 weeks, we've had a little bounce into resistance here around 80.2. Price could rally to the next resistance level around 81.4, but considering we've already seen a three-wave structure to its high, I rate the possibility of a higher high in the dollar this year as very low indeed. And I expect it will begin to drop towards its next support point around 76 and a half within the next few weeks. Longer term, we can't be sure. But then if you're a trader, you don't need to be. As they say at the racetrack, bet what you know. What it means, of course, is that stocks, commodities and metals over coming weeks are going to have room to run.